everybody. Today I want to talk about the beta. When you invest in the stock market, you often see the beta. Here, this is the beta. This is at S&P 500. You can see Apple beta is 1.23. Microsoft beta is 0.8. Amazon is 1.13. So this is the beta of each stock. So what is the beta? I want to show you. I want to talk about the real beta. So when you Google it, say what is the beta, right? So they will tell you, say a beta of 1 indicates the price of the security move with the market. A beta is less than 1 indicates the security is less volatile than the market as a whole. So this is often, being told even in the financial industry. That's how you interpret the beta. However, this is not true. I have here, this is not true when the stock has a little correlation with the overall market. So I want to show you this stock. This is the stamp stock. Here they show you the beta is 0.28, right? So basically say, stamp has a very low beta, which means so it's less volatile than the stock market. Less volatile means less risky. This is not true. You look at the 5 years, the 5 years stock performance chart. The blue one is the stamp. The red one is the S&P 500. So you can see the stamp, the volatility in the stamp compared to the stock market. Obviously, the beta cannot tell you the truth of the volatility. Stamp is way more volatile than the stock market. But why stamp has a no beta? 0.28. So let's see how beta is calculated. We look at this second formula here. The beta is any of the random assets. In this case, it's a stamp. The asset I is equal to the correlation coefficient between the assets I and the market. So this symbol is the correlation coefficient times the standard deviation of the assets and divided by the standard deviation of the market. So you can see, let's say, for example, this is the stamp, the standard deviation divided by the market standard deviation. Here, then you times the correlation coefficient. So if you have a little correlation coefficient, so this number is very low. Let's look at the example of the first beta one. So in this case, your correlation coefficient is 0.2. Then in here is, let's say this is 0.8 divided 0.4. Let's say 0.8 is the standard deviation. Then 0.4 is the market standard deviation. So this gives you the beta is 0.4. If the same standard deviation of the stamp and the market, then you times higher the correlation coefficient, then give you a high beta. So in this case, they just tell you low beta when they have a very little correlation coefficient, then the beta is usually low. Then if they well correlated with the market, so the beta is high. So it's the same, the standard deviation, they are the same. They didn't change, only the correlation coefficient changed. So that's tell you low beta does not mean the stock is less volatile, less risky than the stock market. This is only true when the stock is well correlated with the stock market.